By the end of this video, you'll know exactly which investments actually make sense for you, not in theory, not on TikTok, but in real life. Because the smartest investment depends on who you are, where you live, and what you're trying to build. And if you're living in Europe in 2026, that matters more than most people realize. I'll walk you through every major investment option available in Europe and help you understand when each one makes sense, so you can make smarter decisions from day one. Before talking about returns, stocks, or ETFs, we need to start with something more basic: liquidity. A savings account isn't an investment. It's a financial safety net. In Europe, savings accounts are usually low-risk, highly liquid, and protected by deposit guarantee schemes, typically up to $100,000 per person per bank. The goal here is not growth. The goal is stability and access. This is where your emergency fund lives. An emergency fund is money set aside for unexpected medical expenses, car repairs, job loss, or any situation where you suddenly need cash. Without this buffer, people are often forced to sell long-term investments at the worst possible moment, usually during market downturns. A good rule of thumb is to keep 3 to 6 months of essential expenses in a savings account, depending on how stable your income is. Some European savings accounts now offer modest interest rates. That's a bonus, but return is still not the priority. Think of savings accounts as the foundation layer of your financial system. Low risk, high liquidity, low stress. Once this foundation is solid, then it makes sense to move up the risk ladder. After savings accounts, the next step on the low-risk ladder is fixed-term deposits. They're simple. You lock your money for a set period, 6 months, 1 year, 2 years, and in return, the bank pays you a fixed interest rate. The trade-off is clear. You give up flexibility but get slightly higher returns than a savings account. In Europe, fixed-term deposits are very common and usually protected by deposit guarantee schemes, typically up to 100,000 euros per person, per bank, depending on the country. So the risk here is still very low. But let's be clear about one thing. Fixed-term deposits are not investments. They're not designed to build wealth over time, and they usually don't beat inflation in the long run. Their role is to preserve capital, add predictability, and reduce risk. They make sense when you know you won't need the money for a while, or when you're temporarily parking cash and want to avoid market volatility. Today, many fintech apps let you deposit money and choose how long you leave it there, with higher rates for longer lockups. On the surface, these can look very similar to fixed-term deposits, but they're not always the same thing. The key difference is who holds the money and what guarantees exist. Some are backed by traditional banks and benefit from deposit protection. Others use structures like money market funds or lending models which come with higher risk, even if it doesn't feel that way. That doesn't make them bad products. It just means they shouldn't replace your emergency fund or low-risk foundation. A simple rule to remember: when it comes to cash, higher yield usually means higher risk, even when it looks safe. Fixed-term deposits are about protecting money, not growing it. Once that foundation is solid, then it makes sense to move up the risk ladder and talk about investments that actually build wealth. In many European countries, there are government-backed savings products designed for regular citizens. They work like a loan to the state. You lend money to the government, and in return you get capital protection and predictable returns. Examples across Europe include Portugal, certificados de aforo; France, livret A; Italy, buoni fruttiferi postali; Germany, historically Bundesschatzbriefe; United Kingdom, premium bonds, NSMI. These products are not designed to maximize returns. Their purpose is safety, stability, and peace of mind. Unlike a regular savings account, the money is usually not fully liquid. Withdrawing early can mean penalties, loss of interest, or access only under specific predefined conditions. Because of that, they sit between cash savings and traditional government bonds. More restrictive than a savings account, but simpler and more accessible than buying bonds directly. In some countries, they can also offer tax advantages, such as lower taxation on interest or preferential treatment if held long enough. That's why many people use them as a conservative long-term allocation, sometimes even as a retirement-adjacent product. They won't make you rich, but they can play a role in a solid financial foundation, especially where safety and tax efficiency matter. Now that the foundation is in place, it's time to move up the risk ladder. Let's talk about bonds. When you buy a bond, you're lending money directly to a government or a company. In return, you get two things: interest payments called coupons, usually fixed and predictable, your initial capital back at maturity, assuming no default. That's why bonds are called fixed income investments, because you know how much you're supposed to receive and when. But bonds are not the same as savings accounts. Unlike deposits, bonds can be traded. You can sell them before maturity, but the price will depend on interest rates, market conditions, the issuer's perceived risk, so even if income is predictable, a bond's market value can go up or down. That's where market risk comes in. Not all bonds are equal. Government bonds are generally safer. Corporate bonds offer higher yields, but come with higher risk. They're more volatile than savings, but usually less volatile than equities. That's why bonds are often used to stabilize a portfolio, reduce overall volatility, add predictable income. They won't build massive wealth on their own, but they help create a more balanced and resilient portfolio. Where do you actually buy bonds? Most individual investors don't buy bonds directly. In Europe, bonds are usually accessed through investment platforms or brokers, most commonly via bond funds or bond ETFs. This makes bonds easier to access, more diversified, simpler to manage. At this stage, what matters most isn't where you buy bonds, it's understanding the role they play in your portfolio. When you buy a stock, you're buying a small piece of a company. If the business grows and becomes more profitable, the value of your shares can increase. If it struggles or fails, you can lose part or all of your investment. That's why stocks carry higher risk than bonds. But they also offer something bonds usually don't: long-term growth potential. Historically, stocks have delivered higher returns over long periods, especially when you stay invested and reinvest dividends. Here's the key difference. With individual stocks, you're no longer betting on the market, you're betting on specific companies. Your results depend on the quality of the business, management decisions, competition, and long-term industry trends. This means individual stocks require research, patience, and emotional discipline. A single bad decision can hurt your portfolio. Stocks aren't bad investments. They're just not forgiving. Used well, they can build wealth. Used emotionally, they can slow you down for years. That's why many investors choose a different approach. Instead of picking companies, they buy the market itself. After stocks, let's talk about ETFs, exchange-traded funds. An ETF is a fund that trades on the stock exchange just like a stock. But instead of buying one company, you're buying many companies at once. Sometimes hundreds, or even thousands. This is the key difference. With individual stocks, you're betting on one business. With ETFs, you're betting on the long-term growth of the market itself. That's why ETFs are often considered the smartest starting point for most investors. They offer instant diversification, lower risk than individual stocks, very low costs, and far less emotional pressure. In Europe, ETFs are usually structured as UCITS ETFs, meaning they're highly regulated, transparent, and designed for retail investors. For most people, this solves a big problem. You don't need to analyze companies, follow earnings reports, or worry about one bad decision ruining your portfolio. You invest consistently and let time and compounding do the work. ETFs are especially powerful for long-term investing, monthly contributions, and building wealth slowly but sustainably. They're not exciting, they're not flashy, and that's exactly why they work. For many Europeans in 2026, ETFs form the core of a long-term investment strategy, with other assets added around them, not instead of them. ETFs don't try to beat the market. They let the market work for you. Mutual funds were the traditional way people invested before ETFs became mainstream. They pool money from many investors and invest it in stocks, bonds, or both, similar to ETFs. The key difference is cost and structure. Most mutual funds are actively managed and sold through banks, which usually means higher management fees, possible entry and exit fees, and less transparency. Over long periods, most mutual funds fail to beat the market after fees. So while they can work for most investors, they deliver market-like returns with higher costs. That's why many people today prefer ETFs. Same diversification, lower fees, more control. Mutual funds aren't wrong, they're just no longer the most efficient option. Across Europe, many countries offer tax-advantaged retirement plans. The idea is simple. You invest for the long term, and in return, you get tax benefits. These plans usually come with tax incentives while you invest, restrictions on when you can access the money, and a long-term horizon, often until retirement. Because of the tax benefits, they're often presented as a smart investment by default. But here's the key point. Tax advantages don't automatically mean good investments. What really matters is the costs inside the plan, how flexible it is, and what the money is actually invested in. Many retirement plans simply wrap expensive funds inside a tax-friendly structure. And if the underlying investment is bad, the tax benefit won't fix it. These plans can make sense for disciplined, long-term investors, but they should never be chosen only because of tax advantages. Because at the end of the day, the tax benefit only matters if the underlying investment is good. Real estate is one of the most popular investments in Europe, but there are two very different ways to invest in it. First, you have direct real estate, which means buying a property to rent or sell later. It can generate income and appreciation, but comes with high capital requirements, low liquidity, leverage risk, taxes, and management stress. It's a business, not passive, not flexible. And secondly, you have REITs, real estate investment trusts. REITs are companies that own and operate real estate. When you buy a REIT, you get real estate exposure without owning property. They're liquid, diversified, and often pay regular income. You buy them like stocks or ETFs. That's why REITs often make more sense for beginners. Lower capital, easier diversification, no management stress, much higher flexibility. Real estate can be a powerful long-term asset, but in Europe, how you invest matters more than the asset itself. Direct property is a business. REITs are an investment. Choose based on capital, time, and risk tolerance, not hype. Cryptocurrencies are high-risk, high-volatility assets. They don't generate cash flows like stocks, bonds, or real estate. Their value comes from adoption, scarcity, utility, and network effects, not guaranteed income. That's why crypto should never be your financial foundation. For most people, it only makes sense as a small part of a diversified portfolio, a long-term asymmetric bet, money you can afford to see fluctuate heavily. There's a clear difference between investing and speculating in crypto. Long-term investing focuses on solid projects, security, and custody. Speculation chases hype, leverage, and short-term moves, where most people lose. In Europe, access is easy, but taxes, regulation, and custody matter more than people think. Crypto can boost returns. It can also destroy portfolios. Used correctly, it's a tool. Used blindly, it's a trap. Peer-to-peer lending means lending your money directly to individuals or businesses in exchange for interest. On paper, it looks attractive, higher returns than savings or bonds. But the trade-off is simple. You're taking credit risk. If the borrower doesn't pay, your capital's at risk. Platforms try to reduce this with diversification, ratings, or reserve funds, but there are no guarantees. This is not a bank deposit, and it's not the same as government bonds. Liquidity can also be limited. In some cases, your money is locked in for years, or you can only exit by selling at a discount. In Europe, P2P sits in a gray zone, higher returns than low-risk assets, but higher risk than most people expect. For experienced investors, P2P can work as a small diversification play. For beginners, it's often underestimated. Good returns are possible. Defaults, platform risk, and illiquidity are very real. Treat P2P as supplementary, not foundational. Commodities are physical assets like gold, oil, gas, agricultural products, or industrial metals. They don't produce cash flow, no dividends, no interest. Their value comes purely from supply and demand. Because of that, commodities are not growth assets. They're mainly used as inflation hedges, crisis hedges, and portfolio diversifiers. Gold is the classic example. It tends to hold value when currencies lose purchasing power or when markets are unstable. But over the long term, commodities do not compound like stocks or ETFs. Prices can stay flat for decades, and timing matters a lot. For most investors, commodities only make sense in small allocations, usually through ETFs or ETCs. Not by trying to trade them. They can protect, they can diversify, but they rarely build wealth on their own. Think of commodities as insurance, not an engine. 1. Investing is not trading. Investing is about building wealth over time. Trading is about short-term speculation. And in practice, most retail traders lose money long-term. Forex, day trading, leverage, and constant buying and selling look exciting, but they behave much more like a casino than an investment strategy. If your plan requires predicting the market every week, it's probably not investing. 2. Taxes matter more than you think. In Europe, investment gains are usually taxed, often somewhere between 15% and 30% depending on the country and the product. Ignoring taxes doesn't just reduce returns, it can quietly destroy them over decades. Two people can make the same investment with the same performance and end up with very different results just because of taxes. Net returns matter more than headline returns. 3. A broker choice isn't just about fees. Low fees are important, but they're not the whole story. FX conversion costs, how taxes are handled, whether you actually own the assets, and how easy it is to move your money all matter, especially over long time horizons. A bad broker choice can cost you more than a bad investment. Collectibles and alternative assets can increase in value over time. Things like art, watches, vintage items, or rare collectibles. But here's the key point. They're illiquid, hard to price, and trend-dependent. They can work, but only with deep knowledge, patience, and a long-time horizon. Think of them as a bonus layer, not a foundation. Build your core portfolio first. Alternatives should complement, not replace it.